What's up everyone, Tom here with another video. Today we'll be talking about the latest stock market news along with our technical analysis thoughts on the S&P 500, Nasdaq, Tesla and gold. What does this current sharp decrease in trading volume before possible stock market new highs tell us about the market's future? Should we be worried or should we stay calm during these times? Stay tuned. So as long-time viewers of this channel would know, we're always talking about these put-call ratios, and with good reason. Whenever the market doesn't expect something to happen, that is when Wall Street preys on us, the retail traders. Why do they do this? Well, of course, they want to profit off it, and they want to push the market and push our psychology. So one of the key indicators to find out when that's going to happen is put-call ratios. And why is this? Well, the more puts that are open to calls that are open, means that there is more perceived risk in the market. The lower this ratio is, the more likely nobody thinks that there is any risk in the market, and therefore the more likely it is actually that Wall Street will prey on us, the retail traders. So right now we're at 1.51 and we can see a bit of a decrease in put-call ratios through the last week. Now, why is this significant? Well, we are nearing all-time highs. So it paints a picture of a little bit of less bearish sentiment coming in, even though we're about to reach all-time highs. And you would think there is actually a good chance this is the point where Wall Street may attack the markets. Another thing is that we have not seen put-call ratios this low since that April kind of 7th area and also late in May, during 2 points when you did have a little bit of a spike in the market to the downside. Another key indicator you always want to be looking at as well is trading volume. It makes sense, right? If we see trading volume decrease and we see price increasing, that is not a healthy trend. Generally, you want to see price increasing and volume increasing to show that there is a lot of people in the markets. So who is left in the markets? Is it Wall Street trading right now, or is it us, the retail traders? Well, I'd like to think that it probably is us, the retail traders. And there's a few things I'll be showing you throughout this video to prove that it most likely is us left in the markets, and it's decision time over the next coming weeks for the market indeed. Trading volume is now so low in the markets that we have not seen this usually any times during the year, except for times like Christmas. And that means that we are now at a point where the market does not see risk or reward being worthwhile. We're a far cry from the February kind of highs in volumes during the crisis into March, and it steadily declined with some spikes as opportunity arose during the dip buying process. But right now, nobody seems to be active. At least the big traders don't seem to be there. What else is happening in the market? Well, again, we've been talking about rotations in and out of stocks. And remember, during this crisis, what have we been seeing? Well, we've been seeing things like Amazon, things like Microsoft, Apple, Google. These are now the defensive stocks, and I call them defensive inverted commas because that is the crazy kind of thing about this crisis. Tech growth stocks are now considered defensive. So what we saw last week was a movement into value stocks, things like the banks, things like Berkshire Hathaway, things like the industrials, etc. Some of the money has been pulled out of those yesterday, and that money's gone back into the defensive sectors, specifically the healthcare sector, which has been a bit unloved as of late. What's happening on the VIX, the volatility index? Does that show us something to go along with our volume and put-call ratio analysis? Well, the VIX right now is at a point where it's almost at that 20. We've spoken about how on Wall Street, many traders consider whether the market's above the 20 or below the 20 very key to sentiment in the market in terms of how much risk is currently in the markets. There's no coincidence that we're almost hitting all-time highs on the stock market, and at the same time as that's happening, we're coming down to the 20 VIX average. So at this point, if we now spike up, the VIX could go crazy off this point. If it gets under 20, it's basically saying everything's fine and there isn't any more volatility in the markets ahead of time. If we look at things like gold though, gold's showing us a very different kind of circumstance. And of course, many people by now would know, and if you don't know by now, Warren Buffett invested in a gold company along with many other people out there. They're obviously seeing a level of risk in the markets that makes them think I need alternative assets, and gold has traditionally been one of those. We've also seen a spike in Bitcoin, possibly the crypto gold, and we're seeing a movement in silver and other precious metals. So at the same time as we've got stock markets going high on low volume, we've got the VIX coming down to a very important level, and we've got gold, silver, and several other key metals moving higher along with everything else that's going on. So what is that painting a picture of us for? Well, it's saying that there is a level of uncertainty, but that level of uncertainty is not currently being shown in the markets. We were talking about gold the other day, and we were saying that it moved too fast, too quickly, and I still really stick by that. We were talking about how it's probably going to do that blow-off phase, quickly pull back up, and find some form of resistance around this 61.8 to 76.8 fib. So I'll just draw that up for everybody, because if you haven't been watching this channel before, I think these kind of situations are always very interesting to see. We see that the blow-off occurred, very quick pull-up. I mean, this is only a few days here, and we're back already at that 2,000 level. Potentially between the 61.8 and 78.6, we may now find some resistance with further selling pressure coming in. But that's really not part of the thesis of today's video. The other thesis I want to talk about is us, the retail traders. Are we the only ones left when it comes to trading in the markets right now? It does seem to be that we are definitely making up a huge amount of the trade volume. And I think Tesla is always going to be one of the best indicators of what the retail market is doing. Tesla is traded heavily by retail investors. We've spoken about Robinhood. If you're a Robinhood investor out there, you may have done well off Tesla. Many people love Elon, many people love Tesla, but it certainly is a trading stock at this point in time with huge aggressive moves each day. We also had that blow-off phase that happened a few weeks ago where we basically saw a huge move in Tesla followed by some kind of consolidation here, distribution. And then last night during our live session, we were actually talking about when it breaks past this 1686, it was going to be explosive. If you're enjoying this video and you think live sessions would also be something you enjoy, please remember to also subscribe and of course hit that alert button on this channel right now, as it does help us out and we appreciate it. Another thing is when we broke past the 1,000, we noticed that the retail community pushed it high and pushed it very quick. So that's another indicator of knowing your instrument and knowing who is trading the market right now. So Tesla clearly does show us not only aggression in the market right now from the retail community, but with the volume being low and also the put-call ratio coming down, possibly Wall Street is setting up to steal a whole bunch of our money. And that's never cool, but it is what they do. What about the technical analysis of the S&P 500? What's going on right now? Well, a few things we've mentioned in the weekly analysis is that we've been talking about this 20 moving average. We know that the 20 moving average is sitting currently at around 3,300. We know that the market likes to come down to those levels. It likes to pull down to this 20 moving average. It's already respected it multiple times, and that we're almost at those all-time highs. So we might kind of just dip slightly above this level, sell off, come back into 3,300, and then we'll have to see the next move. But it does make sense to this decreasing volume that we're seeing in the markets right now. There's clearly some weakness here, and the market is coiling before those times. What else is happening? Well, when we go down to the smaller time frames, I think it becomes very clear that we're stuck in a very tight range here with not much movement in the markets. So while some stocks are going crazy each way, it's really more of a classic case of the market is just rotating very slightly each way as people position based on this risk reward scenario. If I was trading the right market right now and I was managing a huge amount of money, I would of course be holding my positions long, but I certainly wouldn't be saying what a great place to enter. I think this is an awesome place to enter right at all-time highs. I'd be waiting for one of two things to occur. Either the market to come down and give us a dip, or if the market did close above, I know statistically that when it does close above, it may move higher, but it statistically will come back and test the all-time highs, and that will give me that dip buying experience and dip buying opportunity. So I don't necessarily need to take a risk in the market right now with a decision. I can wait and see, and that's why those trading volumes are very low as well. It's something that you should always be looking at. So the market is definitely hovering around this zone. I think it's one of those key times that you really go down into the smaller time frames. And for anyone wondering, this is the real market, the SPX, and you always prefer to do your analysis here rather than the futures. Remember, this is when the real trading volume comes through. And as we're talking about during this video, trading volume does count a lot when it comes to the success of your trading long term and understanding what Wall Street's doing. So So we're really stuck between this kind of little zone here, stuck between this 33.60 and this 33 kind of 87 high. We're in a bit of a distribution range here, a bit of coiling in the market, and it will remain to be seen which way things will push. But at the same time as we're seeing the market kind of fail to make all-time highs with that low volume, we have been seeing more movement into the defensive sectors of the FANG stocks and the NASDAQ. So the NASDAQ's made an all-time high again, and it looks set to push for that 11,500. Ironically, it could push 11,500 and we could still see the S&P 500 hovering in the same zone. And I've always said this, the S&P 500 is the clearest indicator for us as traders as to the direction that we want to be looking at for the market as a whole. While the NASDAQ is clearly one of the strongest markets in the world, it is the strongest market in the world right now, we still want to be looking at the S&P 500 technicals first and foremost, as the sentiment there will dictate really what's going on in every single market in the Western world. So it will remain to be seen what happens this week, but definitely there are many warning signs on the horizon for the S&P 500 and potentially for stock markets around the world. Best of luck everybody out there, and remember, if you've enjoyed this video, please make sure to subscribe, hit that alert button, and of course smash the like button if you enjoyed this. And as always, happy trading, stay safe out there everybody, and I wish you the best of luck this week. Bye for now.